Hello and welcome to Leviathan News. Leviathan News is sponsored by you, actually. We have some really cool sponsorship opportunities out there. If you're interested in sponsoring with Leviathan News, you can come to the Squid auction, which we run week to week, and we have this nice little QR code that we put up in our live streams, and you can bid on that. This week is for Curve. I believe they're the ones that have bought us out, but you can use Squid to come in and auction off the slot of the week. And let me give another shout out to Squid as well too. Squid is the token for Leviathan News. We use it in all parts of our ecosystem, and you can actually earn some for writing or doing anything with Leviathan. We're an open contributor network, and if you're interested in launching your own show or creating content or writing for the newsletter, please get in touch because we're always looking for new talent. So please, we love new blood. We want to hear your thoughts and opinions, and so reach out and to learn more about Leviathan News and Squid. All right, let's get on to the show. All right. Welcome, everybody. Today, we have on Term Finance coming back for their second time. I believe we guys had you on last year, at the beginning of last year. So it's nice to have you guys back to talk more about Term. You guys just launched your token just in the past couple of days. And you guys have really bucked the trend on that. And we're going to talk about that. And then we're also going to talk about some of the new vaults and other products that have been built at Term over the past month. So Billy, Dion, welcome, guys.
Thanks, Sam.
Yeah, thanks for having us.
Yeah. So what's been going on? I mean, like last time we spoke, I believe you guys had just launched. It was really in the infancy, and now you guys have had like almost a year to run business development and marketing and grow TVL. So like, where are you guys now?
Yeah, so when we last caught up, we were just in the throes of building out Term and the Term auctions. And Term auctions have been reasonably successful in attracting large and whale users to come onto the platform to borrow stables and ETH against various forms of collateral like LSTs, LRTs, and all flavors of Bitcoin. Even Pendle PT tokens, particularly in this mini bear market, have been super popular to post as collateral and borrow fixed rates against it. In the throes, we've cleared nearly $300 million of fixed rate loans through the auction mechanism, and have continuously added new users and new flavors, and have even expanded into new chains like Avalanche, and hoping to expand into other new chains in the coming weeks. But a major thing that we focused on since launching is the protocol itself is catered really well to professional traders, particularly hedge funds and other large yield farmers that are looking to get the benefits of locking in fixed rates for the strategies that they're offering. But it's really not catered extraordinarily well to like a more passive user. So a lot of the focus in the past few months has really opened up the benefits of the fixed rate ecosystem that Term provides to non-professionals and more passive users. And so there's two products that we've introduced basically in November and January. So yeah, maybe I'll kick it over to you to kind of jump in on those products and how they fit in with the Term ecosystem.
Yeah, so the auctions have been great in terms of capital efficiency and scalability for the power users. But listening to the community, a lot of complaints are just auctions are too hard for your average person. You got a day job, you don't have time to monitor this auction. Auctions are time specific, so if you miss the deadline, then you have to wait another week. So how can you kind of help solve that problem? The first product we launched was the Blue Sheets Earn product. So here, people who did participate in the auction can turn around and list their loans for sale in the Blue Sheets. And it's listed at a fixed rate. There's no change in prices. What you see is exactly what you get. And this allows users to just come at their convenience on the weekends, at night, whenever it's convenient for them, to make a loan at a fixed rate. And that's gotten pretty popular. I think we've done over, close to like 10, 15 million in volume through these Blue Sheets products. The other product is the vaults. Even with the Blue Sheets, you still have to redeem your loans, reinvest your loans. So there's still a little bit of management involved. So the latest product is the vault product. And we built this on Yearn v3. The Yearn team's been around since DeFi 1.0, super trusted. So we decided to build on top of their core vault infrastructure to create curated vaults, where the same kind of curators you see on other ecosystems like MBB Capital, RE7, can come and do all of the fixed rate portfolio management for you. All you need to do is deposit your funds. Any idle capital sits in Aave, super safe. And then as it gets deployed into fixed rate loans, that's all taken care of by the curator, and the vault automates the rest of the operations. That's also gotten pretty good traction there. Over 10 million in deposits currently in the Meta vaults, and we're rolling out ETH vaults soon. So now, besides just USDC, users can earn yield on ETH as well.
Can we talk about the fixed rate loans? Because I think that you guys are one of the few on-chain offerings for these type of like fixed rates. So how's the demand been for that, being in this like special category, which I don't think it's that special. Like, if you're doing like off-chain traditional like actual loans, then normally they have like fixed rates and fixed terms, right? So like, how has that growth been on the institutional side? You said your power users love it.
Yeah, I mean, it's also market dependent, right? So in bear markets like this, rates on Aave are pretty steady. They just kind of sit there, they don't move. So there's not much differentiation between fixed rates and variable rates. But in bull markets, like we had a few months ago, Q4 of last year, interest rates on Aave are all over the place. It's chaos, right? When utilization is high, you see rates spike above 60% multiple times a day, and that could go on for months at a time. So when that happens, it's a very easy value prop for the borrower. So you have no idea what you're paying, rates are all over the place, come to term, lock in your rate, and have certainty as to what you're earning. And similarly on the lending side, rates were really high just 3-4 months ago, and then they plummeted. But if you locked in your fixed rates, as a lender, you have a lot more certainty in terms of what kind of yield you're going to be earning. So I think that's the best part about term, is just exactly what you're going to get. There's no guesswork involved, and it's stable. So yeah, I think it is more difficult in DeFi. With fixed rates, you can't have these standing liquidity pools on demand. So that's why we created these vaults and Blue Sheets to kind of smooth out that process.
What's the typical rate spread between fixed and floating that you've seen?
Typically our loans on term are relatively short, 4-week loans. So the rates are kind of similar, but I think the key value add here is that on term, we don't sit on idle liquidity, right? So on Aave, for example, right now, 50% of the supply is unutilized in USDC. So that's diluting your yield. Right now, borrowers are paying 5% on Aave, lenders only earn 2.5%, because the other half of that supply is not doing anything. So it's very easy for term to come in and clear an auction somewhere between 2.5 and 5, so that borrowers are saving money and lenders are still earning more. And so with these short dated loans that have been very popular, and it's a very, very clear value prop, everybody does better.
Do you think there's a demand for like longer term, like quarterly or half-year long loans, or is that just too far out because of the rate volatility?
No, there's definitely demand for that. That gets, as you get longer term, it's more and more institutional, and the kind of minimum sizes that are looking to borrow are also much larger. So it's just a process of over time bootstrapping up to that market.
Yeah, because I know that for some stablecoin farmers that are using like ETH and BTC as collateral, like that's a really powerful, like product to use to lock in your rates, right? Because I've seen that like the variability of stablecoin borrowing and ETH borrowing can really be detrimental to your like actual farming if the rates jump up, right? You may go from a positive yield position to negative overnight, just depending on market movements. And so I do think that like this is something that probably a lot more people should be using. It's just that they need the education about it to learn about like why they would want to take a fixed rate loan versus a free floating loan.
Yeah, and our users have been the best kind of advertisements because they're going to their friends in the biz and extolling the benefits of their ability to lock in the rates on term, and that's been a huge driver of new users entering the ecosystem. So that's always the best is when others are telling you about the product versus like us marching and beating the drum, and is always the most successful in converting people. And as we're still around, still coming in, being consistent and offering this product set, it's just been a wonderful driver of building new adoption and building more nodes within the network.
Mm-hmm. Yeah, and so let's talk about this vault, right? So like for me who just maybe has some USDC or ETH or something, like do I just come and deposit in it and then it gets applied to whatever strategy is being run?
Yeah, exactly. You just come deposit into it. We have various carriers. You can look at what collateral they lend against in general, or we have a meta vault, which simplifies the whole process. The protocol itself allocates across all of the various carriers, so you don't have to worry about picking and choosing, and it just helps to diversify the portfolio. And yeah, the way we think about it is, look, worst case, you're going to get the Aave rate because that's where idle liquidity sits. But most of the time, you're going to do better than Aave because rates on term are typically higher than what you get supplying on Aave. So you get the benefit of, you get the best of both.
Well, that's pretty cool. And how's the uptake been on that?
It's been solid. Yeah, it's been solid. So we've seen deposits flow in. We launched the product in January and have eclipsed 10 million. We reached up to 15 million as of recently. And right now they sit about 11, 12 million in TVL within the vaults. And I think the other thing that the vaults unlock is more integration opportunities with other protocols. So we've seen the initial set of risk curators to be some of the people that you'd see on Morpho. Dion mentioned like Re7, for example. But it also enables us to facilitate more integrations and partnerships with other protocols. So I'm not going to kind of get ahead of myself and get in trouble for naming any names, but I think it's going to be pretty exciting, the types of integrations that we're planning on announcing in the next several weeks that will massively increase the supply available on term. Just to kind of loop back, historically on term, borrow demand has significantly outstripped the supply available. Again, the value prop of being able to lock in those fixed borrows is huge. And the major constraint for the protocol has been to be able to onboard sufficient supply to unlock some of these major borrowers whose minimum tickets are 10, 20, even as high as 50 million. And so some of these relationships some of these curators and integrations that we're working towards will help solve and alleviate some of those supply issues that have kind of limited the growth of the ecosystem and the protocol to date.
Yeah, it's interesting that you talked about the rates earlier. Did you say they were somewhere between like 2.5 to 4 or 5?
It always varies against the collateral that borrowers are posting. So like BTC related loans right now, we're clearing, borrowers are willing to pay a slight premium because they're locking in the fixed rate. So we cleared a few million yesterday against CBBTC, borrowing USDC at about 6%. Against some of the PT tokens like the Athena Pendles that mature in May, we're seeing interest in lending somewhere in the 4.5%, 5.5% range. But still, that's a decent yield pickup from what you're getting, on a protocol like Aave at the 2.5% supply rates right now.
And that's for USDC, or it's for like stables, right?
Yeah. And then on ETH, it's also ranges against the collateral type. Last week we cleared a few hundred or nearly 1,000 ETH at about 3% against wrap staked ETH. And then some of like the newer kind of farming tokens like TETH from Treehouse, borrowers are willing to pay up to 5% to borrow against that collateral type. So I think the collateral is a really big driver, and the perceived nature of the collateral is a big driver on the ultimate rate that lenders are willing to receive and ultimately what borrowers are willing to pay. But Term utilizes isolated lending pools, so you're only exposed as a lender to a specific asset, and you have the flexibility of charging an appropriate market rate for making those loans against those collateral types.
Yeah. And like, how do you see this? How do you see like ETH lending developing? There's been all this talk about like ETH is suffering, ETH is collateral has been like losing its shine, people have said, and that we're in this process of migrating away from like ETH as a primary L1 to other L1s like Solana or Athena's launching their own L1 here in the next year. Like, how do you see the evolution of the ETH lending markets taking place?
I think it's still, ETH is still the largest, blockchain native token. So ETH created a lot of value, a lot of wealth, and all of that because it is native to Ethereum L1 stays or sits on ETH mainnet. So there's always this pool of capital on ETH mainnet that can be tapped into. The value fluctuates over time, as we've seen. But to get that onto an L2, you still have to bridge it. There's still a lot of friction. So I think the primary source, the place where all of the ETH borrowing and lending will happen is still going to remain always on ETH mainnet. These new L1s like Solana, like Sweet, they're getting decent traction. But the market caps still aren't anywhere close to where Ethereum is. So I think for now, it's just most of the capital still sits on Ethereum, whether you like it or not.
Yeah. Yeah, I think the biggest indicator for network usage and also how much network power you have is just stablecoins by market cap. It's probably the clearest example of where investor demand is, because like lending markets are one of the prime drivers of stablecoin usage. And if you just follow where the dollars go, it gives you a really clear picture. And so ETH by far and away is the largest place where people are depositing stables and using stables. So what's the plan now to scale up, right? What is the current TVL like? It's like 40 or 50 million at the moment, or?
Yeah, that's about right.
60, yeah, depending on how you count it, but like 60 some odd.
Yeah. So like, how do you scale that into, like 9 to 10 figures?
Yeah, I think the big thing for us is the big unlock will be onboarding more supply. So, hopefully we can come back in the not too distant future and announce some of these major ones that we're working towards. So the borrower demand has always been there to unlock, 10 figures. The thing that we're really pushing towards is building out the distribution and to onboard kind of new capacity into the ecosystem. So working with various exchanges and aggregators to be able to pump that stablecoin and other asset supply into the market to really unlock the major borrowers that have demand for the fixed rates and are attracted by how doing it on chain is typically cheaper than lending through CeFi counterparties. I think another unlock will be form fitting to help meet the the largest institutions that are looking for a TradFi like experience. So I think ultimately that will bring permissioned style markets where various counterparties are whitelisted in order to transact within other whitelisted and approved counterparties within an ecosystem. So I think those are kind of two main drivers to see these types of platforms kind of really take off and hit like the sizes that traditional finance are seeing today.
Yeah. Well, cool. I think I think it's good to see the growth. I mean, it's up and to the right, which is what you want to see. It takes time to build consensus around the contracts. They kind of have to be out there for a longer time before people tend to trust them. And the more lengthy these contracts get, the more TVL they can accept in. So, and it's also a function of like BD and marketing as well too. So I hope you guys can continue and grow the 40 million into 400 or essentially 4 billion later down the road. But I think the thing that I had the most questions about was the launch of the term token that took place a couple of weeks ago, and why you guys chose a centralized exchange in 2025 for its launch versus a DEX. We've heard a lot of stories recently about the exploitive practices of, say, Binance taking like 8 to 10% of a token supply just to get it listed, or the quite distasteful contracts that you would need to sign with a market maker for them to take your token and bring it on the exchange, and the ongoing fees and the call options that they set up. And usually it's been like negative EV to have these centralized exchange token launches for the past like year or two, really since post FTX. So I'm just wondering, like, what was the impetus to go and launch on a centralized exchange? And I know you guys are on Kraken and MEXC, which I think are great exchanges. I love Kraken. They're one of my favorites. It's what I use. But why there?
Yeah, no, I think that's a great question, and totally on the same page with you in terms of all of the criticisms. That was the driving principle behind how we approached the entire process, really. For on the exchange side, a lot of these exchanges, they ask for, token allocations, sometimes extremely large, percentage points that ultimately, get dumped on the community, right? That token is unlocked and either handed out as rewards, or, who knows who's getting those rewards ultimately. But either way, it ends up finding its way into the market in short order. So you're renting short-term attention, with unlocked tokens that you dump and sell out in the community. So we definitely wanted to avoid that. As you mentioned on the market making side, same thing with misaligned incentives. You give out unlocked token loans, these call options, which ultimately either the market makers will dump after the price appreciates, thereby increasing, circulating supply, or they just dump and then try to buy back at zero. Either way, they make money, and it doesn't really matter to them, how they make their money. So we definitely want to avoid that too. We were lucky though in our journey. We came across Kraken. Kraken didn't charge any fees, so we didn't have to worry about that kind of predatory practice. And on MEXC's side, they were actually one of our seed investors. So we were able to list on them. We give them a small 120K token allocation to create a staking pool for the community, and they match that with USDC rewards. So it's kind of one for one, dollar for dollar matching, and relatively modest in the amount. There are some benefits to the CEX listing, of course. The benefit of wide unit at all is that it's much more capital efficient. If we're able to, we found a market maker that is aligned, a good friend of ours. We've known him for over a decade, started at Citibank back in the day with one of our co-founders to help, do it as kind of a friendly service. We can give much more liquidity to the community through a CEX than trying to put it in like a standard curve style DEX pool. Because everybody is aware now at this point of the inefficiencies of DEX. A lot of that capital is supporting price ranges where the token's never going to trade. So ultimately, the same dollar for dollar, you get a lot less liquidity for the community. That's why we decided to go with the CEX at all. And we are going to be launching, the market is going to be launching a DEX pool soon. So I expect that to show up in a day or two. now that the market has really stabilized.
Yeah, but you can use like you don't have to use like Curve or a V2 contract. Where there's, the Uniswap V3 contract, which allows you to essentially mimic the order book on chain. I think that like you guys have a special case in that, Mexi was an investor, and then, Kraken is a good entity in this space and isn't out to charge an arm and a leg about these things.
Yeah, I mean, don't get me wrong. We got offers that were ridiculous, which we turned down all of them. We saw a lot of those offers and just straight said, no, we're not going to do that. So yeah, I mean, if you can get a reasonable listing, it's not a bad thing. But yeah, definitely do not, kind of follow the crowd and just accept whatever they ask for. And it's true, they can get better elsewhere, but it's just not a game that we want to play.
Yeah. Yeah, I think the things that I see is just that when it's on the centralized exchange, you don't really know what's happening with the tokens, or like who's buying or who's selling, especially when it comes to like if there's like team tokens or some sort of advisory tokens or any sort of project connected tokens that are like moving on to the exchange. It gives the ability for certain people to like sell without having a trail of what's happening. If everything is on chain, then you can see like, oh, this team member who was, because all the allocations should be like marked publicly about who gets what and how the tokens are distributed. If it's all in chain, then they can't hide that, right? And so I think the transparency helps in many cases to, especially in the first couple of years, to prevent any sort of negative externalities from happening, or
Yeah, I think the key is
conflicts of interest.
follow the foundation treasury safes. So for us, we have a DAO safe that holds the tokens on behalf of the DAO. We have a foundation safe that holds the foundation tokens, and you can trace those movements. You see movements from there going, and also all of the insider investing tokens are also on chain. So we're using Magna. So you'll see all of the vesting tokens go into Magna. You can see all the details of the vesting. So yeah, in terms of how we did the rollout of, allocating the tokens across the various entities, all of that is extremely easy to trace on chain. So it's still possible. You can see, which tokens are moving on exchange and see what pot of money that's coming from. And from that, there's still a fair bit of auditability.
And I think an important thing for Term from the get-go when we were raising from our investors is to ensure that the team and the insiders' unlock schedules are, very long. So using like the 1 year cliff and then 4 year kind of linear, and enabling the community to really form in a way that, is not predatory like you tend to see with other projects where they have very short vesting schedules for team advisors and insiders, which is kind of a net can build a negative downward cycle within an ecosystem. So that was really important for us to also align with investors that also had that vision, and so everyone is on a very long time frame to be vested. And the most important thing is to build out the ecosystem, build value into the ecosystem, and do that in a way that's constructive to everyone within the community. Maybe Dion, it's worth transitioning.
To that point, we actually had turned down investors who were not down with the 1 year cliff, 3 year vest, and so that term itself really self-filtered out the credit.
I mean, those aren't like real investors.
Exactly, they're like token traders, really. So it's good to get them, off the cap table.
It's funny because like if you try to do that in the real world of like, hey, I've got a company and I want to put you on a 3-month vesting for your options or stock that you're buying, like you get laughed out of the room. Like most traditional VC funds have like a 7 to 10 year time frame for seeing any returns.
Exactly.
Liquidity is a blessing and a curse all at the same time. And so trying to, form fit the ecosystem with kind of what makes sense for basically what a startup, is it's a, preformed entity that ultimately, hopefully, builds into something that's extremely valuable. But there has to be governors around that.
Yeah, I mean, the way that I see it is that like the token just juices whatever sort of product market fit that you have, and if people like the product and they're using it, the token is like like your marketing expense pretty much to bring in more capital. If you don't have product market fit, people will just take your token and dump it because they don't assume that you're going to grow in any meaningful way, and that it's just here's some free money that I can take and we can send this token to zero, while well, the team doesn't really know what they're doing. But the best ones really like find product market fit, and the token is really secondary to everything that the product is. Like we don't talk about we rarely talk about like the curve token, other than in the case of like Michael's loans that he had, right? Nobody's going out there and saying like, oh, it's they don't talk about the curve token first. They talk about the product, like the swaps and the lending and stuff. Same goes for most of the other like incumbent DeFi protocols out there. It's always product first, and the token is second. I think that, as my good friend Dimitri, aka Back the Bunny, says, you build for weight, and the market's it's a voting machine in the short term, and it's a weighing machine in the long term. So you have to build for weight.
Yeah, that's exactly right. There's no shortcut. The only secret is you got to build a product that has real product market fit. And that's actually one thing that I also noticed. Like a lot of crypto now has flipped it on its head. People are coming for the token, and then once the token is gone, they don't care about the product. So there's a lot of fake metrics, a lot of window dressing there. And that's not something that we want to do. You don't see us going out there with major token points campaigns. Like we have a points campaign. We want it to be a reward for real users, but we don't want it to be the primary reason that you come to term.
Yeah.
And you see that more and more now.
Yeah. So what I hear from you guys is that there's a lot of special circumstances that allowed you to get a nice deal with both the exchanges and the market maker that you're using, which a lot of teams might not have. And so I think that you said, Dion, that you had some other offers come in, but they're really laughable. So if you are planning a token launch out there, be wary, because it's sharks, and they're just coming to max extract from you.
Yeah, I think we're fortunate because a lot of us on the team have trading backgrounds in TradFi. So when we talk to these market makers, we know what kind of games they're playing. We know the value of these loan call options that's actually being given out. A lot of founders, they're just builders. They don't have any financial background. And I think they get taken advantage of, honestly, just from lack of knowledge. So, yeah, I think we're kind of in a special situation to really be able to evaluate and push back. And, ultimately just find a friendly, because you can never trust what they're doing. Once they have the tokens, you have no idea what they're doing. And the only way is to find somebody that you really trust.
Just to wrap up on a different topic, Circle announced that it's going to IPO this week. Have you looked into it? Did you read the S1 at all?
I have not looked into it. I know they were trying to IPO way back through a SPAC or something like that.
That's correct. Yeah. So 2 years ago, they had tried to SPAC. Originally at about $5 billion, and then towards the top of the market, I believe they raised it up to $9 or $10 billion. The SEC sat on their hands and failed to approve the SPAC during the window that they had, and so the deal fell apart. And now they're coming back with another IPO where they're valuing themselves at about $5 billion, and they should be going. I think the IPO should be in the next month or 2 or 3. I don't. It's going to happen this year, though.
Yeah, I think the main thing that I saw is I haven't read the full S1, but the main thing I saw is just the power of distribution in the relationship and in the privileged position that Coinbase has, and the amount of revenues and fees that they're able to generate from the relationship is pretty staggering. Circle and also just shows the power of Tether and their business model and how they've been able through the relationships with Asian centralized exchanges to build a pretty significant moat and to be able to capture a lot of the value. I think is also just maybe even an advertisement for the business that Tether has built. But overall, I actually bought some of the SPAC because I was excited by Circle and their overall business prospects, and I think their overall business prospects are still super, super strong.
Did you get your money back?
I did 10.
Okay.
I think I invested at like 10 and a quarter and got back 10. So lost a little bit of money, but what are you gonna do?
I think that is a good point though. Like, what are you buying? Because if half the revenues go to Coinbase, I just buy Coinbase instead, or am I buying half of the business? So I think I would want to like dig into that a little bit more, because that's a pretty big chunk of the business revenues not being owned.
Right. Yeah, from what I understand, the majority of the expenses are being paid to Coinbase because Coinbase has their like earn program where you can take USDC and earn they call it a reward, not a yield, or interest or whatever they're calling it. Coinbase uses it for marketing expenses for USDC on their platform. And I think this persists, right? Where I think USDC's primary function that they're going to be is that they want to be like this like neutral stablecoin layer, where they have BlackRock on the back end who's managing all the money. They have their distribution partners who they'll have to pay out either expenses for the yield that they earn, and so I think their margins stay pretty low in the long term, just when it comes to the interest income. And based on the S1, it looks like they're trying to build themselves out as more of a technology and services company, so they can build APIs or like other systems that allow for like institutional usage of USDC, and they would make fees through that. And I think that right now that's about like 99% of their income comes from interest income and 1% comes from services. And I think they'd like to at least get that like equal down the road. That would be a success for them.
But I mean, the interest part is so juicy. Look at Tether. That's like, I think the revenue is like rival, or the profits rival JP Morgan's, just sitting on T-bills doing nothing.
Yeah. I don't know. I mean, like my belief is that all these stable coins, they get commoditized heavily. Like it's going to be a race to the bottom in terms of like fees and how much they pay back in expenses. Like I know that Agora, which is a stable coin launched by Drake from Frax, they give something like 80 to 90% of their interest income back to the institutional partners that they have. And their belief is that, look, we think this is a commodity. We think that this is a race to the bottom. And so we're going to focus on, again, like technology services, so that we can make fees there rather than trying to make money on the asset itself.
Yeah, that's right. It probably ends up getting shared over time to grow market share. But I would push back a little bit. Do you think that USDC and Tether are in a place where it's going to be really hard to knock them off? As being first movers, they got all this infinite liquidity on DEXs, right? If you're in the Tri pool, you're set, right? Tri pool was from like 2-3 years ago. There were only 2 stable coins. It was Tether, it was USDC.
Yeah.
At the Tri pool, and there's so much liquidity there that's dead. People just forgot about that money. Whereas like a new project, they have to pay so much in incentives to get a little bit of liquidity. And as soon as you turn out the incentives, liquidity disappears.
Yeah. Yeah, I think we've kind of seen that with PayPal's dollar. It's been launched now for a year, and I know that they have not been integrated to the same extent that USDC does. It's really just like a time and marketing issue, right? But when I think about it, I'm not thinking about like on-chain DeFi stuff for the next couple of years. With this new stablecoin bill that's going to be passed, we're going to have big players come in: JP Morgan, Walmart, Facebook, any sort of like private company or bank is going to have a really high incentive to come in and like launch their own stablecoin because of how the model works, right? Either they use the USDC model where, you know, they have their own, like if it's a bank, if it's JP Morgan, right? They're really incentivized because they could have the collateral that backs up the stablecoin go into their money market funds. And then they could issue this stablecoin for people to use within their banking system or to use for like interbank swaps. And I think that the end goal for all this stablecoin discussion is really supplanting the euro dollar, which is 100 times bigger than what DeFi is at the moment, or 1,000 times bigger even. Or maybe
I think there's two different use cases though, right? Because the euro dollar is like bank deposits, that's institutional flows, kind of aggregating all the retail stuff in each country. And then there's like the retail flows, which is more like a PayPal, Venmo kind of use case.
Mm-hmm.
I feel like the euro dollar market, that's going to be, I think JP Morgan already has like a tokenized like deposit that they trade only amongst like the large institutions. But that they will never allow that to go into the hands of retail because now you have OFAC and all that stuff.
Right.
So it might just bifurcate. You have like two different versions.
But you know, if Libra had come to market, right? Do you think that it'd be the same size as USDC right now?
Well, it's still kind of late, right? Like Curve was already established, DAI was established. Like even DAI is still around even after they rebranded. It's just like
right.
There's so much.
Yeah, but Facebook has 2 billion users or whatever that they.
Yeah, that's where I think it'd be interesting, and building in payments within the platform and making that as frictionless as possible, particularly for like ex-US sort of users to be able to purchase through the platform. So you get a real like flow within an ecosystem. Yeah, and having that distribution is super powerful. So it could have been extraordinarily successful.
I still think it could be. We're probably going to see like Facebook launch something as soon as the stablecoin bill gets passed. Like, why wouldn't they? It just makes sense. Like, they have 2 billion users that they can activate, and it's like an easy addition to like their marketplaces. And
why not X? Like Elon Musk could do it.
I think that I think that he's probably working on it at the moment. You know, because he wants X to be this like all-in-one payment platform.
Super app,
yeah. And I mean, if you just replicate what the Asian markets have, it seems like social is a really good way to kind of facilitate economic flow.
Yeah, I don't know the Asian markets well enough to.
They have like WeChat. Like you can do like a million things on WeChat.
People pay on WeChat. Yeah. You just pay each other.
With Tether?
No, they have their own kind of. It's centralized. They have their own centralized payment system like Venmo, but you could do like a decentralized version.
Right. Yeah. Oh, yeah. It's like you can use WeChat just to like it links up to your bank account, and you can just.
Yeah, people don't even use cash anymore in China. Like you bring cash, nobody will accept it. Just like I gotta pay using WeChat.
Yeah. Yeah, I mean, I'm excited. Like, I look at the like traditional securities world, and for me, there's only like 3 investable assets at the moment, which is Bitcoin, the ETH ETF, or Bitcoin ETF, ETH ETF, and Coinbase. I've looked at some of the other stocks. None of the Bitcoin miners really make sense to me. They're so capital intensive and hungry. We had like crypto banks for a while, but they all got shut down. I think I'm really salty about Silvergate because I invested in Silvergate at IPO when they launched, and I was really excited about that. It did like a 10 or 20x or something, and then the SEC and FDIC and all the 3-letter agencies just sent it to zero.
Yeah, that was a big shakeup for everybody.
Yeah, so there really hasn't been any. And maybe I'm wrong about this, and one of our listeners or you guys can correct me on this. There really hasn't been a great like stock to invest into, like crypto stock, and I'm sure this is partially because of Gary Gensler's SEC and just wanting them to keep people from holding it. But if you can buy BTC, there's no real reason to buy like MicroStrategy or any of these other like Bitcoin holding companies.
We've had some pretty big sales recently of like stablecoin infrastructure.
Mhm.
The name is it Bridge or one? I can't remember the name of the entity that was scooped up by.
Stripe.
Yeah,
Yeah.
exactly. So it's also just like how stock markets have kind of formed. Like IPOs are, people are raising capital on a continuous basis through other means versus going public. And so acquisitions are probably more realistic exits for most of the businesses.
Yeah.
So it is actually nice to see like Circle and here Kraken is working towards IPOing. So it's good to see more businesses. I think there's also been the advent of I think Bitwise created a product with any company that has at least 1,000 Bitcoin or I don't know, it's 100 or 1,000 Bitcoin on the balance sheet. They've created indices to basically allow people to gain exposure to those companies. Like those are cool products and kind of crypto adjacent. So there's like some pharma companies, obviously MicroStrategy and others that, and Tesla that have Bitcoin on the balance sheet. So you're able to kind of get dual exposure to kind of non-core crypto businesses that have crypto related exposure. So I think you'll see a lot more of that too, because the IPO market seems to be pretty dead.
Yeah, I mean, it comes in fits and waves, right? Maybe we'll see a change this year, but hopefully the new SEC regime essentially allows for people to come in and do more IPOs. But we'll see. Well, cool. Thanks for going off in this tangent with me to talk about Circle. They are one of your biggest lending assets, so I think it does affect you guys how they perform over the next couple of years.
Yeah, in term, and they invested in a term in our seed round, so they also are somewhat tied to our success too in a very modest way compared to their overall balance sheet. But no, we're big fans of the USDC product and stablecoins in general. I think the stablecoin meta, like you mentioned, is just getting started. It'll be interesting to see how it evolves. It looks like we're going back to like an 1800s monetary system where every financial institution has their own stablecoin and their own currency. So obviously, I think that'll benefit the folks, like Curve, and it'll be interesting to see how lending protocols are able to kind of aggregate the liquidity across similar assets that exist within the stablecoin ecosystem. So something I'm particularly focused on.
Yeah, I think it's a good thing. My whole complaint against the banking system is just that the banks, the GSIBs like JPM or JP Morgan and whatever, shouldn't be both the issuers of money and then also the primarily responsible for the creation of credit as well too. We have this really weird system where the American housing market essentially backs up the US dollar, and I don't think that's healthy for the long term. And moving towards this like narrow bank system it might tighten credit, but I think it's good. Like there's nothing wrong with higher interest rates. It should bring down asset prices, home prices, and allow for like young people to invest in those things. When you start to get to like these low interest rate environments, it really distorts things and creates.
That's what you would think, but this is random off tangent. But looking at houses recently, the suburbs, nobody wants to sell at a loss. So even though rates have doubled, they're like, nope, I want to mark up my home. So it's almost like you just got to pay the same dollar price, double the mortgage, and nobody wants to mark it down. So we'll see.
Yeah, but that's what when I talk about like the U.S. housing market, I don't know what happened in other ones, but almost everybody refied or bought houses when rates were at 3% or 4%, and so now when they're like 6 or 7, they're stuck because like they can't sell. If they're going to sell, they're going to get a worse house with
like double the mortgage.
with double the mortgage, right? And they don't want to accept a markdown on their homes. Like that's why I was saying that period of low interest rates just really distorted everything about the market. And I think that's all like post 2000. It's just hangovers from post 2008 where there's just so much government intervention into the banking system. they should have let the banks go under. They should have let the bad debt get washed out. It would have been way worse in the short term, but over the long term, we wouldn't have these like terrible, like long-term knock-on effects that we're seeing that happen in the credit markets and just everything else. So
it's one of the big drawbacks of like the mortgage versus the housing market is mortgages are relatively liquid and, homogenous in terms of how they're priced, but then houses are super illiquid, and the rate of flows within those markets are significantly mismatched. So, I'm worried personally about like the Florida housing market and how that kind of impacts the rest of the US, because it seems to always be the biggest, the canary in the coal mine.
Indicator, yeah.
Yeah. And now like trying to buy a house and get insurance coverage in Florida is totally fucked because of, all the natural catastrophes that they've had, which, I would think will ultimately, in the cost of mortgages going up, will ultimately impact the cost of housing in that market, which has kind of been crazy. So, I saw some like terror porn, like I don't know what you call it, but like some, terror porn on, when I was doom scrolling last night before bed about, the housing market in Florida. And I'm like, oh, fuck, is this going to be the thing that just like unpulls the thread and causes the next calamity here in the US? The good or the bad thing about that is those sort of things take time because housing is so illiquid.
Yeah. And, Florida's going to be underwater anyways. I have a house in Florida, so I'm not worried about it.
Mortgages or, for serious. So, but yeah, that's a different story for a different day. But
30-year fixed rate loans on ETH and BTC at Term Finance coming soon.
Let's do it.
It's it's a liquid, high quality asset. It's volatile, but at least like the volatility is
more liquid than your house.
It's more liquid than your house. Yeah, and it's less volatile, but is it? No one's giving you a price minute to minute, day to day. So volatility is can be your friend, and it hopefully also on the risk management side, you're getting a price. And there's deep liquidity within that market. So I do see like people gravitating towards these highly volatile liquid assets like Bitcoin over time as real, even as stores of value in like traditional sense of having like a, like your house being relatively stable over time, but, being something that's anti-fragile.
I think it's more than that. I just think it's because it's programmable and because it's so liquid. There's no other asset where you can get access to capital as quickly as with ETH and BTC or other assets on chain. Like this is the thing that always amazes me. Like if you have stocks or if you have a house and you want to take a loan against it, it's really like pulling teeth because you want to take a HELOC. There's just like piles of paperwork that you have to fill out. You have to get an assessment. If you want to take a loan against your stocks, like they may only let you take like 20% LTV. And it's not great. Like crypto is really the only place where you have these just insanely liquid borrowing markets that have access to like secured borrowing at any time, right? I wouldn't even call it borrowing. It's more like you're selling
it's like borrowing, yeah, because there's a penalty if you end up getting liquidated. So
it's like I think of it as put options. Like it's because
of the penalty, right? Because we charge an extra penalty for defaulting.
Yeah,
so people
but it's more about like I think it is like a put option, right? You're selling a put option against your collateral, and the fee that you pay. If it gets assigned or liquidated, right? It's just being assigned, like your put option.
Yeah, it's similar. It is similar, yeah.
Yeah, because like a loan has like commitments, and a loan is very different than what we give on through like term or any other sort of like crypto lending service. Like what you guys are offering and what most other crypto loan or like Aave or whatever like lending facilities are offering is essentially like, okay, you can essentially free up some collateral or free up some credit against your position, but somebody else can like call that in case it goes below a certain strike price. I don't know. It just makes more sense to me to think about it as an option rather than a.
It is, yeah. No, it is very much so. And I think having the penalty is a key part of that, avoiding it. Because if you do, you just take it as a free option. Okay, if it goes down, I sell, no loss to me, I got my money. And people become less vigilant about, keeping it in good health. But yeah, otherwise it is exactly that. It's basically just a free put option that the lender has extended to you.
Yeah, I mean, even the way that DeFi runs liquidation is, I would say more robust than what the traditional financial system does with margin calls. Because the value of your collateral dips below a certain level, you're being liquidated to help maintain lender health and maintain health within the ecosystem. Within the TradFi space, you've seen, plenty of instances where those margin calls and the trust me bro that happens between that window of getting called on margin have caused financial institutions to collapse. I mean, I think that's what basically led to Credit Suisse getting sold to UBS, was that particular downfall.
Yeah. All right. Well, I'm sure we could go a lot longer, but
I think there's one little thread I wanted to pull
sure.
before we jumped off. So I think a major thing within the especially with tokens is tying the success of the protocol with the token and linking those. So Dion, I don't know if you want to quickly jump into some of the thoughts we have and areas we're pursuing there.
Yeah, and last little tidbit, make it quick. Staking is coming live soon. The model is borrowed from the Unistaker contract. And the idea is very simple. Stake your token, you're required to delegate your vote. As part of that staking process, you can delegate to yourself if you want to. And in the long run, you'll earn a fixed share of protocol fees for participating in governance. Still early stage right now, so it can't be like burning all of our runway on protocol fee share. But the idea is once you hit a certain milestone, we'll be able to turn that on. So yeah, that's something we'll look forward to.
Yeah. I think the majority of token projects probably turn on fee share too early. You need to hit escape velocity. Like, how many growth companies do you see paying a dividend?
Dividends, yeah, exactly.
Right? It doesn't exist, and I think this is something that we fail to capture in crypto, is that, or maybe there's just a distrust of teams spending money, and that investors would like to have it back. And that you wouldn't go into a tech company that's providing lending services and say okay, it's been a year now, look at your $50 million of loan book that you have, let's start paying out a dividend now, right? You would wait until there's 100 million or 500 million or a billion or 5 billion, right, before those sorts of things. Once you've kind of hit that mature state and you're no longer focused on growth, because I'm sure all the fees that you guys collect could go back into growing the pot even more and bringing even more.
Extending the runway, building out more infrastructure.
Exactly right.
But it is critical. You do need to. I think it is critical to tie those things together for the long term.
Yeah. Well, cool, guys. I appreciate you guys coming on. Everybody can go and check out term.finance, unless you're American like me. But very interesting fixed rate solutions. I think it's definitely needed more, because if you're doing some yield farming or other types of mainly the yield farming, right? You really want to lock in those rates, and especially having it on a 4-month rolling basis is pretty cool. So go check out Term Finance. And Dion and Billy, thanks for being here today, and we'll talk to you guys again soon.
Thanks, Leslie.
Take care.